So hi all, this is Akshara Menon from PMS Bazaar, welcoming you to today's session on the topic passively active investing. Today, investors look for smarter, cost-efficient, transparent ways to participate in the markets. ETF-based PMS strategies are gaining a strong traction, blending the discipline of passive investing with the opportunity of active alpha generation. Our speaker today, Mr. Karan Bhatia, the co-founder and co-fund manager at PriceBridge, represents a new way of thought. Karan manages the Honeycomb ETF portfolio at PriceBridge PMS. He brings a sharp understanding of equity markets, finance, and real estate. An economics graduate from University of Exeter, he has developed a research-driven approach to constructing portfolios that leverage ETF efficiently and effectively. So I'm not taking much of your time. I'll just hand over the podium to Mr. Karan to look forward for his presentation. And before that, for all the audience out there, I would request you to put your questions on the Q&A box, which will be taken after the presentation, and also not to ask any stock-specific questions. Thank you. So over to you, Karan.
Thank you, Akshara. Good evening, everyone. Thank you so much for taking the time out and joining us here. Thank you to the PMS Bazaar team for having me here and attending the audience. I'm going to keep today's presentation very short, to the point, just put across some data for you guys to see, mainly on the active versus passive investing ecosystem. And if time permits, then towards the end, I can take some questions as well. So to begin with, let's just look broadly what is passive and what is active investing. I'm sure most of the investors over here are very well informed. Yeah, here you go. So active decision making is more of strategic asset allocation carried out by fund managers. These fund managers aim to outperform their respective benchmarks. They actively take decisions of buying, selling, holding, not holding, being invested, not being invested. Whereas the passive investing is a more structured manner of gaining exposure to the broader market using low-cost products such as index mutual funds or ETFs. And these are very inexpensive, very low cost. Fees are less. And the aim here is not to outperform the index, but mainly to mimic sort of the underlying index that they're taking exposure to. And most people believe that active decision making is right for them because fund managers are meant to outperform. They will give you higher returns, but should understand higher returns comes with higher risk as well. And contrary to the popular belief, most active fund managers do not outperform the respective indices. So just to put some data in front of you all, the overall market in India and this is not just now, this is from back in the early 2000s as well, majority of the Indian equity mutual funds have underperformed their respective benchmarks. And the SPIVA India report has been highlighting this over the years. And as you see, the underperformance is not just now, it's right from the year 2005. And as the time period increases over a longer time period of 5 years, of 10 years, the underperformance is very, very significant. If you see in the large cap segment, over the 5-year period and 10-year period, the underperformance is 93% and 74%. Even in the mid and small segment. In the shorter terms, few fund managers might actually outperform the benchmark, but in a longer time period, it is very, very difficult to outperform the benchmark. And this is a trend that's been going on for years now, and this is going to continue for years. It is not easy to outperform the benchmark at all. Fund management is a very difficult job. And this data suggests that passive index funds may offer more reliable and more safer long-term investor solutions compared to active strategies. And even if you are able to sort of outperform the benchmark in the shorter term, in the longer term, it's very difficult. And as an investor, if I have to choose which fund to put my money in, it is very difficult to choose which fund is outperforming now, which fund will continue outperforming. Historically, outperformance does not guarantee that in future the outperformance is going to continue. See, most investors, what they do is they go to, there's a lot of data available on returns of PMSs, AIFs, and mutual funds. PMS Bazaar is a platform that showcases such returns. Most investors go to these platforms and they will filter in the last 3 years or in the last 5 years, which are the best performing mutual funds and best performing PMSs. And investors typically go and put their money in that. But historical outperformance does not guarantee that the performance is going to continue in the same manner. So it's very difficult to pick and choose funds or pick and choose fund managers to do it over a longer period of time. Why is Warren Buffett so popular in the world? Not because his returns have been fantastic, but because his returns have been fantastic over decades. To continuously do that year after year is a very, very difficult job. So outperformance is one simple thing which shows that passive investing may be a little more efficient than active investing. The second thing that shows switching to passive products is more efficient is the cost. So here, when you look at the total expense ratio across fund categories, if you look at the regular versus the direct mutual fund structure, the costs are significantly different. And in a passive investing product like ETF, the costs come down even more significantly. The difference between large cap, mid cap, small cap, flexi cap across the board, there is a massive difference between regular mutual fund, direct mutual fund, and a passive product like an ETF. So not only is your money being invested in, what I'm trying to say is that there is more money being invested over the longer time because the fees are lesser. So if you're investing, say, 100 rupees today in a direct mutual fund, such as the Nippon Large Cap Fund, 1.5 rupees is going towards fees. Whereas in ETF, only 0.04 rupees is going towards fees. So there's a larger quantum of money that is being invested. So over a longer period of time, this is going to make a significant difference to your investment corpus. If you look at it this way, lower expenses in ETFs mean more money stays invested compared to regular mutual funds. And over a longer period, this can run into lakhs and crores. A lot of investors do not understand the power of compounding when it comes to lower fees as well. So it's not just in terms of returns, but it is returns net of expenses as well. So in India, the passive AUM market has been growing rapidly. So currently we're at about between 12 and 13 lakh crores, which implies about 17% of the total market share. And a lot more investors are being, being more educated by the day. And this is showing in the trends of the passive AUM growth. There's a significant shift towards passive investing. Investor awareness is growing in terms of cost efficiency and efficient portfolio management. So out of the passive AUM in India, the ETF ecosystem is approximately $107.82 billion. So this is approximately 9 lakh crores. And 9 lakh crores, we have over 264 ETFs launched in the market. And there's significant growth and in the trading turnover that's been observed over the years. Now, these numbers might seem very large at first glance, but if you compare it as a as a percentage of market cap or a percentage of GDP, it's hardly 2 or 3%. And if you compare it to a matured market like the US, the numbers can be really astounding, because in the US, the ETF ecosystem has reached about $12.7 trillion. There are over 4,300 ETFs in the US market. And if you see, this is about 12.7 is about 40% of the US GDP, or it's about 25% of the total US market cap. So India has a long way to go, and there's a lot of catching up to do. Not that it's a like for like comparison between India and America, but this just shows you that the growth in the ETF market, although has been great, it's still at a very nascent stage. There's a massive push in ETF, even from the regulator in terms of EPFO and other regulatory changes. And there's a lot of AUM that's going to flow into passive investment, more particularly into ETFs. So if you look at this table, in the year 2010 to 2015, the passive investment share was only about 1 to 3%. And in 2020 and in 2025, it's gone from 7.3% to 17.3%. Now, if you look at the global trend, 17% for India, 24% is in the EU region, and 51% of the activity in the US happens through passive investing. And I just want to point out that in the year 2017, the massive change or the massive inflow that's happened into passive products has happened post 2015. Over because of a couple of reasons. The first is the EPFO, where they started allocating a higher percentage of the money in the employee provident fund towards ETF investments, and the threshold went from 5% to 15%. So the flows of EPFO have been coming in consistently over months. And in 2017, 2018, the regulator made a couple of changes. So the first change that they made is most active funds were actually benchmarking themselves against the Nifty price index or the respective benchmark price index and not the total return index. Now, these funds were putting in money in various stocks or asset classes, and they were gaining dividends as well. So the outperformance that they were showing was the price appreciation plus the dividends. Whereas the Nifty benchmark, the price index was not accounting for the underlying dividends that the stocks were generating. So the dividend yield was in the range of 1 to 1.5%. So the outperformance was actually shown because the dividends were not being accounted for. And it's only the when the total return index came into play, when you could actually see the underperformance more than what this PIBA report shows. And another regulatory change that the regulator has made was a lot of funds, even though they were calling themselves as large cap funds, they were putting in money in mid cap or small cap. And if the mid and small segment was doing well, the performance against the large cap benchmark was showing outperformance. But that was just undue risk that these funds were taking by putting in money into segments other than the large cap segment. So a lot of people ask me saying that how can you build an ETF portfolio? Now it's ETF is a great tool which gives you access to various asset classes, primarily equity and debt. But not just that, you can gain exposure to precious metals such as gold and silver. You can gain access to global benchmarks as well and invest globally. So just want to give you a few examples. Under equity, there are various indices that have been launched in India, and these can be categorized as broad market, sectoral, thematic, strategy indices. So in the broad market, you have Nifty 50, Next 50, 500, mid cap 150, small cap 250, large, mid, small, various segments. You can take sectorial bets as well and gain sectorial exposure in different sectors like banking, financial services, IT, auto, metal, pharma. You have different themes that have been launched over the years. You have the EV theme, you have the tourism theme, Nifty defense, Nifty railways, energy, housing. And there are now strategy indices as well, which NSE has come up with. So you have Nifty equal weight, Nifty 100 equal weight, Nifty top 10 equal weight, Nifty 150, quality 50, Nifty 500, value 50. So you have a platter of ETFs that you can actually invest into and gain exposure into, primarily from an equity perspective. You also have global ETFs. You have the Nippon Hang Seng Bs, you have Mirai Asset FANG Index, you have Motilal Nasdaq 100, you have even the Hang Seng Tech Index. So you have a lot of options now as investors in terms of asset allocation, in terms of market cap allocation, in terms of thematic allocation. So you can really build a robust portfolio that covers, or sort of an all-weather portfolio that covers all these asset classes and all these market caps. Now, I'll not be able to tell you which sort of ETFs to invest into or which market cap segments or sectors to invest into. But one thing I can tell you as investors, awareness is very important. And while you're selecting any ETF, there is three main things that you must look at. The first and the most important is the expense ratio. So the expense ratio minimizes costs, and more of the returns are generated while keeping the costs low. So you have, if supposing different fund houses have a simple Nifty 50 ETF, you can look at what each fund house is actually costing and what each ETF's expense ratio is, and take an informed decision accordingly. Liquidity in ETFs is another important factor. ETFs, as you know, are traded on the exchange, and there's a buy and sell bid. There's a spread between bid. Now, as the ETF market in India is developing and becoming more mature, these concerns are being addressed too. Market making activities are being done very actively. A market maker in between has to basically buy or sell based on the bid-ask spread. And this is also being looked at in a very strong way by the regulator. So another thing to keep in here is each fund house basically has to display the INAV, which is the intraday NAV, on their website. So if you go to each fund house's website and check for the INAV of that particular index or that particular ETF, you will get the NAV. And while you look at your trading screen, you can compare how much is the bid-ask spread compared to the INAV. And once you place your bid or ask as close to the INAV as possible, it's the market maker's duty to sort of fill that order. And this is getting better by the month. Third is the tracking error of ETF. It basically is a measure of how closely the ETF's return is to the benchmark. And ETF, it's more to do with standard deviation, because as ETFs mimic the benchmark, there can be bounces in between. And over a period of time, how much on average is the bounce from the return that the benchmark gives is the tracking error. A fund with a lower tracking error should definitely be invested into compared to one with a higher tracking error. Even if the expense ratio is a little bit more, the tracking error will make up for that expense ratio. Now, this was basically, building a portfolio and investing into ETFs. Now, can you actually deliver alpha over the benchmark using an ETF portfolio? Yes, you can. And how do we do that? You have all these methods of doing that by using factor tilts, rebalancing, smart beta funds, diversification into different asset classes or different market caps, and obviously risk management in terms of overall portfolio weightage. So how do we do this at PriceBridge? I just wanted to give you a couple of examples. This is how our existing split looks like in terms of a diversified ETF portfolio. We have 83.45% in domestic equity, 2.5% approximately in foreign equity. We have 4% in debt, and 9.75% in silver. So this is basically like an all-weather portfolio, and which gives you access to different asset classes. And in the equity split, we have market cap based splits, we have sectorial splits, we have factor based splits, and these are actively managed, but using passive products and active risk management. So what do I say when I'm talking about active risk management? Just to give you an example here, this is one of our this is the silver ETF that we've invested into. And full disclosure, we are still holding a good position of this 9.75%, like I showed you. So if you see, we had three different purchase prices. And as silver had started rallying earlier this year, towards the end of this year in October, position sizing is something very, very important that we look at in terms of managing weights and managing risk. So as the position size was going up, we sort of try and book profits and build and reduce the exposure and keep it in checks with our risk management system. So although the buying was at much lower rates, the selling also that we did, we sold 25% at first, 15%, and then 10% at the top. And this is basically how we manage risk in terms of passive investing. So it's being active in passive investing, but in terms of risk management, not in terms of alpha generation as such. And few other methods of doing this is making certain switches which deliver alpha to the portfolio or by mitigating risk to the portfolio. So in the middle of this year, in July, August, we made a small switch in our portfolio where we exited the FMCG index, and we held almost 7% of the FMCG index, and we split it equally between the Nifty oil and gas and Nifty metals. So as you can see here, the Nifty FMCG index has delivered a negative 1.39% return in the same period, whereas oil and gas and metals has considerably outperformed with 6.76% and 10.3%. At the same time, in a similar period, we made another switch during our rebalancing, where we rebalanced our portfolio and made a switch from the Nifty 200 Momentum 30 index to the Nifty 500 Value 50 index. And like you can see, again, this small switch basically delivered a 1.5% alpha in the returns of our portfolio. So this is basically the strategy returns compared to the benchmark over a 1, 3, 6 month, 1 year, 2 year period, and since inception. So the aim is to keep the returns in line with the benchmark. The strategic rebalancing and the strategic allocation will not only help in alpha generation, but it will also help in bringing down the overall risk of the portfolio. We do not like to take any undue risk. We do not like to overexpose ourselves to any sector. We do not like to overexpose ourselves to any particular stock. So when we go through our holdings, we not only look at the asset class, the market cap, the sector that we've invested into, but we even go much deeper to understand what each ETF is holding. If supposing if my ETFs, if I have HDFC Bank, in 5 of those ETFs, I look at how much weight of my overall portfolio is allocated into HDFC Bank specifically. How much weight is allocated to ICICI or Reliance or TCS or Infosys. So overall, the idea is to mitigate risk and deliver benchmark returns and try and generate that extra 1 or 2% alpha over the benchmark that will help compound over the next 10 years. So I'm happy to take any questions going forward on the same topic. And Akshara, over to you.
Thanks, Karan. I think that was a very quick PPT, I would say. And when we spoke earlier, you said you're not a public speaker. You can't
No.
speak for long, but it didn't seem so.
Yeah.
What you were saying, that's true. But yeah, let me jump out of the question. Of course, it's a compliment. Yeah.
Thank you.
So,
my aim was to just keep it, concise, to the point, and inform the investors of, the benefits of passive investing and showcase how a passive portfolio can be built, a robust passive portfolio.
Yeah, you also mentioned that, you're passively, doing the active alpha generation.
Correct.
That was the, whole purpose of this paper. I think
Yes.
that was delivered well.
Thank you.
So if I could ask you the first question, when it is an ETF-based portfolio, the investor's mind just goes into ETF. Any retail investor can buy it for themselves. Correct.
Correct.
So
Yeah.
could they choose an, fund manager to maintain an ETF-based PMS portfolio? If someone should approach you to, handle an ETF-based portfolio,
Right.
would they, approach for Honeycomb? Is what
Yeah, right. Yeah. Good question, Akshara. I mean, we are not your traditional buy and hold mentality. As you can see, we are looking to generate that alpha, but by keeping the risk down. So in terms of making switches in asset class or making switches in terms of sectorial themes, not all retail investors are that well informed to take such decisions by themselves. Okay, and not understand one thing: ETFs are passive products in general. they are not sold. So a lot of people are not aware of these products. They are not
Okay.
sold for the primary reason that the distributor in between does not make money on a passive product because of its low cost. So a lot
Yeah.
of people are not very well aware of ETFs and how to use ETFs efficiently. ETFs are bought, they are not sold. So as for various investors, making such decisions is not always ideal.
Okay. When you said that, ETFs are bought but not sold, like what would trigger and sale in your portfolio then? Like if you have, n number of ETFs, then now how would you decide that, this ETF doesn't work, so I need to pull money off from this? What makes you decide that?
So that is mainly to do with our research systems, our that we've developed over the years, our quant models. I don't want to get in too much into that at this point and keep it more of an educational and informative talk here. So on research, we'll probably do another webinar with you.
Fine. I think I get that. And moving on to the next question order. Whenever you say that ETF-based, PMS, first question that comes to investors' mind is about taxation.
Hmm.
And it's been cost efficient also.
Hmm.
So I just want to hear from you, like what about the exit load, intraday volatility, and taxation, like about that.
Yeah, fair point. In terms of see intraday volatility, exit load is zero. That's very standard. That's simple. Intraday volatility, people talk about in ETF. Actually, intraday volatility can be used to your advantage and not necessarily to your disadvantage. If you remember the silver chart that I showed you at the top, we had on the top candle, we had sold 25% of our silver holding. So if you go back to that day, I remember we had sold it at around 179 rupees per unit during the intraday volatility spike. And that same ETF closed at 168 rupees, if I'm not wrong. So the intraday volatility can actually be used to your advantage. And in terms of taxation, see, you're paying tax if you're making money. You're paying tax on the gains. If you're not making money, you're not paying tax. So taxation is very standard in India, long-term capital gains, short-term capital gains. So that should not be too much of a concern to an investor as long as he's making money.
Okay. So because I just take one thing from what you said right away, because you had allocation towards silver. Yeah, you
Yeah.
had allocation for your domestic. I had allocation foreign. I think foreign was very, very minimal, around 2% is what I remember from your PPT.
Yeah.
And then you had, debt also a bit, and then silver. But you have seen gold has rallied a bit
Yes.
lot actually this
Yeah.
year.
Yeah.
If you see last 5-6 years, gold rally was not that great. And your allocation towards gold, is it that, or how do you
Uh,
see it?
no, our allocation is primarily towards silver. For the very simple thesis of gold and silver are hedging mechanisms which different institutions use to hedge against currency risk, to hedge against inflation risk, and they fulfill the same purpose if you see. So silver, the advantage is that not just it is a monetary hedge, but it also has a lot of industrial application. And going forward in EVs, in solar, in semiconductor, there is a percentage of silver that is being used in all these products. If you have a very simple outlook of, at one point of time, all cars in the world are going to be EV, silver is
Oh,
a good investment allocation to have. And there are more technicalities to this, the gold versus silver ratio, or the supply and demand of silver globally, the physical silver coming out of the mines being in shortage. There's a lot more technicalities, but let's not get into the technicalities of that.
okay. And I was asking about the foreign part. I think in the paper you just mentioned it was like 12.7 trillion dollar is the ETF that is being used in the in US market.
Yeah, that's the size of the ETF market in America.
Yeah, I think
Yeah.
that's you. Correct. So you still mentioned that India is in a very nascent stage, very small stage. So
Yeah.
you see the growth, like how next 2-3 years or next 10 years. Let's 10 years or a
Yeah.
longer gap. So where do you see India would stand in this ETF PMS space?
See, as you can see, the data that I showcased you that passive investing is the more efficient way to go forward.
Hmm.
Okay. Active investing has, for decades now, majority of the active managers have not been able to beat their benchmarks. And this is not something new. This is going to continue for the years to come. Okay, there is no change in the human behavior and human mentality overnight that this is going to change. So the adoption of passive products has been very strong over the last 10 years, and it's going to continue to be very, very strong. Again, I mentioned that a like-for-like comparison with the US may not be fair because of the size of the economies are very different, but you can get a fair idea of where we are heading in terms of passive investing.
Okay. So actually, where I'm heading, like, if you could complete that, like, okay, let's not compare from US. Let's take our own thing. So where are we standing now as an ETF-based or passive investing, and where do you see as a fund manager? Where do you see this going forward?
It's only going to go up. It's only going to go up. This 17% allocation will go to 20%, 22%, 24%. You know, in India, we have so many equity investors now. For example, just to give you some rough numbers, I think if I'm not wrong, the number of ETF portfolios in the year 2020 was close to 18 lakh folios, and it was 5 lakh for index fund. In 2025, this has gone to 1.4 crores for ETFs and 75 lakh for the index funds. So 18 lakh going to 1.4 crores. So if we have around, say, 5 crore, 5.5 crore PANs linked to mutual fund, and say 13, 14 crore equity investors in India, then the number is going to be exponential. Out of the next 10 crore investors that come in, 25% are going to be passive investors.
That's true because most of the household savings are coming into equity now. I think with that the numbers you have said, it's very much achievable.
Yeah,
And
yeah.
liquidity is the foundation for the ETF-based execution. Yeah. So if in India, in Indian market, Indian ETF markets, if it is moving from the current turnover to into 3x liquidity, there's more liquidity in the market, for example, and next 3, 4, 5 years down the lane. So how do you feel? What do you feel like if the alpha part is going to shrink because the spreads get tightened up, or do you think your execution is going to improve if the liquidity is more?
No, execution is going to improve for sure. As the more the liquidity risk comes down, it's another risk to your portfolio and the risk to your return, the liquidity risk. So as that risk comes down, the efficiency of alpha generation will be higher. Not that alpha generation is going to be easier, but I'm saying in terms of efficiency, it's definitely going to be higher. It's one more risk that is taken out of your portfolio.
When you talk about the risk fact, I think, see, off late in last 1 year, it wasn't that great, for the equity markets with us. And, most of the quant funds were underperforming because, they were led by the momentum.
Correct.
And momentum led by the narrative. So if Honeycomb it's a sector agnostic because you were talking about multiple sectors that Honeycomb was into, and it is also based. Yeah. So how does this Honeycomb is going to prevent chasing the momentum? Probably it can be late also, but chasing momentum, or how do you ensure that this rule-based portfolio doesn't miss the momentum?
So again, it comes down to systematic investing. If your quant systems are very efficiently developed, then you will get the right signals at the right time, whether to stick to momentum or stick to value investing or stick to the more frontline. Like I mentioned the Nifty top 10 equal weight index, which just invests in the top 10 companies of India. It's going to be a matter of active fund management decision, but if your systems are good, it's going to take care of the rest.
Okay. So while talking about Honeycomb, yeah. See, if it is moving it's more like a scaling thing. If today if you're at 500 crore AUM, and if you're going to move to 2,000 crore AUM in future, what was the first that was to break? Is it the execution, or is it the alpha, or is the flexibility? Because after one point of time, there's always a threshold cap, and every fund manager put for a strategy. Is there something like that into yours?
No, nothing at all. For us to go to 500 crores to 2,000 crores is not going to be challenging at all. And liquidity in the ETF space is increasing. As I mentioned, the market making activities are becoming more efficient. And now another thing that the AMCs have started doing, SEBI has basically guided the AMCs to allow basket buying directly from the AMC. So if I'm a large ticket investor, I can basically go to the AMC and directly purchase the ETF units directly from the AMC. The threshold is very high now. It's a minimum of 25 crores of a basket, but it is possible. So if I want to buy 100 crores worth of one ETF, I can do it tomorrow. It's very much doable.
So the raise of UAM is not going to, disturb the performance or the
not
alpha.
at all. Not at all. Not
I
at
think that's great. So let me take a question from the audience. I think that's a question that bombarded now. The first question from Jane is that what is the churning ratio, and can faster churn, maybe monthly, can produce better alpha?
No, it's not necessarily that, your faster churn will generate alpha. And churn is something that is it's very agnostic, based on different market conditions. If the market is more volatile, the churn might be a little bit more. In a more stable market, we like to typically ride our investments and let the market do the rest. So the churn has not been much. In terms of rebalancing the portfolio, we usually rebalance about 10% of the portfolio every 6 months, to give you a fair idea of what we're doing.
So it's not monthly rebalance.
No.
Okay.
We look at it on a weekly basis. So if there is a particular signal that gets triggered and some sort of switch needs to be made, it is made. But on average, between 10 and 15% of the portfolio is churned every 6 months.
Okay.
Yeah.
So I'll move to the next question. So if you want to answer this from Narendran, what % of a portfolio should be allocated to ETFs? It's a general question.
If you ask me, 100%. So that's my take.
But actually,
Because you can get like I mentioned, you can get exposure to various asset classes, various sectors, various themes. Everything can be done using ETF as a tool. So you don't necessarily have to have ETF as an asset class by itself. Not that this is my equity allocation and this is my ETF allocation. And you can get everything under one umbrella of an ETF.
okay. So I'll move quickly to the next question, which is Rashmi has asked, what is your view on silver ETF as an holding above 9%? If you want to take this.
Yeah, I can talk about it. So typically we have certain thresholds where, any position in our portfolio or any investment, the weight typically does not increase more than 15%. And if you see even the silver, the profit booking that we did is because we did it because our silver investment, the weight went above 18%. And as risk managers, my primary aim is to mitigate risk in my portfolio, is to bring down the risk, bring it below the benchmark risk. Then the beta of my portfolio should ideally be below Nifty's beta. So at silver at 18% after a sharp rally, it made sense for us to trim down the portfolio. So we trimmed it down from 18 to 8%. And similarly, going forward, we'll do the same regardless of the sector, regardless of the position.
Okay, I'll just quickly move to the next question from Jyoti Nath. See, I assume a similar or very similar portfolio can be constructed using index funds. Any indication of cost of ETFs versus index funds?
See, that's a great question. Index funds and ETFs are very similar in terms of costing. They are similar in terms of holding anyways. Both are passive products. They hold the same underlying benchmark or the same underlying index rather. The only major difference between an ETF and an index fund is that an ETF is an exchange traded fund. You can buy and sell units on the exchange. Whereas an index fund is, you typically have a day-end NAV similar to a mutual fund, and you can purchase it based on the NAV of the previous day. They are not traded on the exchange.
Got it. So actually, many are asking about the fee structure that can be taken offline, or you have Swapnil also helping out with those questions. So quickly, I'll move to the next question from Nishad, is that I see an advantage by investing in passive ETF with respect to expense ratio. But since it is anyways actively managed, the risk of choosing a wrong sector or timing still has a significant impact on the portfolio, right?
Correct.
With respect, it seems same as an active fund. Please explain.
Correct. You are on the right path by asking these questions, but understand that we are not active fund managers in where we are actively making decisions of buying and selling. We are making decisions in managing the risk, not in alpha generation. So our aim is to basically get out of sectors which are showcasing downside risk and try and be in sectors where the downside risk is minimal. So I'm not an active fund manager to beat the benchmark and show you saying that benchmark is delivered, say 12, 14% return over an X number of period. My portfolio is giving you 25% or 24% or any ridiculous figure like that. My aim is to give you returns either very close to the benchmark and give you 1 to 2% alpha by not increasing the risk versus the benchmark.
Okay, and the next, many are asking the same question, like how many holdings, the number of ETFs is there in the domestic part of your portfolio?
So we have, it varies because we don't have a model portfolio as such.
Right.
Our portfolio is more tailor-made to each investor coming in at different times of the market. So, Nifty at 22,000 will have a person who comes in as an investor with us when Nifty was at 22,000, his portfolio might be slightly different. Nifty at 24, 25,000 might slightly be different. There will be a lot of overlap. But typically there's about 10 to 15 in the bracket of 10 to 15 ETFs in each portfolio.
Okay, so like if you just answer the domestic, if you want to answer the foreign, which was 2%, if you want to
No,
answer.
that was just one ETF, which was the Hang Seng ETF, and that we've been investing from a long period of time. The weightage was a lot higher. The weight was close to 8%. Right now, as you can see, it's less than 2.5% now.
Okay, and next question from Jane is like, why don't you increase a percent of gold ETF? Is it not very good idea in present market situation? If you already answered it, but if you want to add it on.
I don't want to tell you what to invest in and what not to invest in. That's not my aim here in terms of specific bets that you should be taking. Gold and silver as an asset class is something that we are bullish on. Silver is something that we are more bullish on compared to gold.
Okay. The next question from Vinod is that, no, not from Vinod. I'll take the question. What is the long-term tracking error of your ETF, and how do you minimize it?
So I don't have an ETF of my own where I can tell you that what my tracking error is, but typically in the industry, an ETF with a tracking error of 0.1 to 0.2 is considered okay. And we very closely look at tracking errors of different fund houses. So we do not purchase an ETF with a high tracking error.
Okay, so I think it's a more follow-up question on the same thing. Why does same underlying index ETF have a different expense ratio?
Because the manufacturers of these products are different. Similar to you buying an iPhone versus the Samsung or any other phone, the phone they're going to do similar function of calling, sending messages, etc., etc. But pricing is set by the manufacturer.
Okay, I think with that, I think most of the questions were taken. I think it's quite, people are behind your product deck. So I would request, Karan or Swapnil who is there in the call to, answer the question which was not taken on air today. And
Sure.
and also, I'll be sending you the details if you could share your product deck with them, and that will be easier for them to understand about the product even better.
Sure. You can put my email out to anyone who is interested in getting in touch. Please get in touch with Akshara and she'll give you my email and we can take this offline also.
Okay, so thanks, Kiran. That was a great show, and I think you explained so much. Though you said that you are not a public speaker, you don't talk much. It was more like 40, 45 minutes a full talk show version of yours. Thank you thank you for that.
Thank you very much, Akshaya. Thank you everyone for attending. We are very glad that you could take some time out of your busy schedule and be with us here today. Thank you.
Yeah. Thank you, audience.